Hey friends, Ernie here, Trader of Futures. It is Monday, 1 p.m. on the East Coast, and today I am broadcasting from Martha's Vineyard, beautiful island off the coast of Massachusetts, just below Cape Cod, the home and playground of rich and famous, and also a fair smattering of working class people that make this island go. It's a beautiful place. These last couple of days, it's been a little bit overcast, a little bit of rain, unusual for this time of the year, and I think we expect that to continue on for the next couple of days. But generally, this time of the year, it's beautiful. And regardless, this island is so beautiful. There are so many things to do. You don't have to spend all day at the beach. There are fantastic trails, at least 5 different very unique townships where you can go shopping, look at some historical sites. There's just a million things to do here. Visit the vineyards, visit some of the overlooks. Really, really an incredible place. Unsurpassed, in my view, in its beauty, with some of the, or at least one of the most beautiful beaches in the world in Aquina. So, anyhow, today I wanted to talk about statistical arbitrage. Now, I'm not going to get into a lot of the heavy-duty math of arbitrage. I'm going to start with something very simple that's easy to digest. And that's because, there's a lot of ways that you can look at statistical arbitrage. And you know that I've been talking a lot about what are some of the holy grails, in my view, of trading. What are the strategies that actually work? The strategies, and I've often said, in a sort of an encapsulated way, that the holy grail of strategies, the holy goal of trading, involves 2 things. One is a systematic approach, and in that system, you're essentially developing this kind of OODA loop. Look that up. Look up OODA loop, with a continuous improvement process built in. The other thing is that what you trade, you're trading multiple non-correlated strategies. Now, correlation is a statistical term. It has a very specific meaning, but essentially what it means is that the things that you would use to enter the trade, manage the trade, and exit the trade, those trading signals are very different from one strategy to the next. They are completely unrelated. And then as of such, their returns should also be unrelated. So while one may be doing very well, another one might be experiencing a drawdown, while another one might not be in a trade at all. Some may be short, some may be long. Now, what hedge funds do is they'll trade a wide range of different assets this way, and then pair them all up, trying to put things in there that have very low degrees of correlation. Correlation essentially means that, say you had 2 things, and when one's going up, the other one is going up. Something in that case, that means they're highly correlated. Let's suppose that one's going up and the other one's going down. That would be a very low degree of correlation. Let's say that over time, there's really no relationship between when one's going up or the other one's going up or down. It doesn't matter. And then you would have what I would call a very low degree, or a 0 correlation. When you're trading 2 different things or a set of different things, what you want to do is you want to have 2 things that have together. Let's just take 2 separate assets like gold and silver, or 30-year and soybean oil. When you have 2 things that have a high degree of correlation, you can hedge them against each other. You can trade one long and then the other short. And what you're looking for, no longer are you looking at the overall direction. that they're going, whether they're going up or going down, because they're highly correlated, they will both go up together and down together, but that relationship that they have, that spread between them, will constantly be changing. So as they're going up, it's changing going up. As they're going down, it's changing going down. That amount of variance is going to continue to change. That amount of variance should be relatively in check with each other. And the reason for that is that they are very similar by nature. Now, hedge funds get a little bit more sophisticated than that. They choose a lot of things that don't have real tight correlations like the ones that I just mentioned. So they choose a whole basket of stocks or futures and match them together. And then they have a statistical way of kind of measuring how close they are and then provide for all the variance and all this other stuff. That's way, way beyond the average retail trader. But dealing with statistical arbitrage between two things, and then maybe trading a few of these different types of relationships, are relatively simple. Bitcoin is very interesting because it has very, very little relationship or correlation to virtually any other asset that's out there. It has virtually no correlation to the markets, no correlation to the dollar, no correlation to precious metals, no correlation to energies. You can go on and on. So what do you trade it against? That's a good question. You could trade it by itself along with other statistical arbitrages, or you could maybe trade Bitcoin in an arbitrage with the cash position versus the futures position of Bitcoin. That might be a good option because there may be some variance there. You could trade, say, Bitcoin with some of the major altcoins like Ethereum. But I found that trading the cash position of these cryptocurrencies is a little bit difficult. Easier to stick with a cash position versus the futures position, for instance. As Bitcoin emerges and becomes more mature and there's more involvement with institutions and we have more derivatives to put in the mix, doing a statistical arbitrage is going to be it's going to be much easier with Bitcoin. But right now, not so easy. And to create an arbitrage between Bitcoin and some other thing, even if you find over a long period of time there might be some relationship, you may be able to introduce some or identify some statistical factors that can kind of smooth out that relationship, kind of force it, but I don't recommend that. What I'm more interested in is finding strategies that work. And why would you trade pairs trading? Why would you do statistical arbitrage? And the reason for this is when you have two very, very similar things and they're highly correlated with one another, and then that correlation breaks down temporarily, it will either spread apart or narrow that correlation. And then after things kind of settle out, it will then regress back to its mean or its sort of natural correlation. There is sort of a natural, smooth correlation between two highly correlated things. And when that happens, you can take advantage of that. So when it spreads apart, it will then eventually come back together. When two things are very highly correlated, there's actually almost a deterministic amount of probability that they will come back together. That's an edge. That's a real fundamental edge that you can take advantage of. In fact, when the degree of correlation is high enough, we start approaching what appears to be about a 75% probability that these two things that spread apart, that are very similar, will then regress back to their mean. So imagine that you're trading something that has a probability of 75% to come back to its natural state. That is a huge edge. You can increase that edge through various other methods, and I'll talk about those in the future. But here we're talking about something that has real determinability. Now, I've talked a great deal and I've taught how to trade notes over bonds. Those are treasury futures products. Notes being things that are attached, things that are related to 10-year treasuries. They're called notes. Anything over 10 years is considered a bond. So a 20-year, 30-year, 30-year ultra, those are considered bonds. But typically we trade the 10-year versus the 30-year. And then when we trade them together, what we're really trading is what some people call trading the yield curve. And it's a very highly predictive thing that you can trade. So I'm just kind of introducing the whole concept here right now. You might wonder, well, how do you trade these things? You always trade them as pairs, first of all. Always trade them as pairs. So you always trade one side of the pair and then the other side of the pair together. You enter them as pairs, you exit them as pairs. You do not leg in, you do not leg out. Because you're not trading the individual assets, you're trading the relationship between them. And why is this really important? Well, for one, you're not going to have to worry about direction. You don't care if it's going up or going down. Because you only care about that relationship. You only care about the relationship. Hey, I'm recording here. This is one of the problems of not being in my confined space. So again, you're only trading that relationship, and that relationship has a very tight bond to it. And that's why it is so significant. There is no statistical probability that if something goes up that it's going to come down in terms of price direction. However, that correlation, that relationship between two very highly correlated things, when it breaks, it does almost always come back to its normal resting place. So I'll be talking about this a great deal. So this is statistical arbitrage, and perhaps I can show you some different types of statistical arbitrage that I might trade. I didn't really prepare anything here at the moment, so it's probably not useful to show right now. But let's just say that this is one of the most deterministic ways to trade. A very, very high degree of probability of the trade succeeding, and especially if you're trading with futures, a very high return on investment, return on your capital. That's because, especially when you're trading futures, when you trade two things together, two highly correlated things, the CME group, the people who are primarily responsible for being the stewards of all these different futures assets, they attach a margin that you have to satisfy for each individual thing. But when you trade them and go long and short, long one, short the other, they recognize that as a hedge, and they'll provide you with a substantial discount. As a matter of fact, with notes over bonds, you can get a discount on that pair by as much as 85%. So you're trading with a very, very tiny bit of capital. And the movement on those things can be substantial. So the potential return, especially if you're trading with this arbitrage in mind, is very high. And I've talked about this a great deal. Besides, this is one of the things that you're always trying to achieve. A low degree of risk with a very high degree of return on capital, or a high probability of a trade actually going your direction with a high potential for return, with a very low cost. That's your return on capital, the amount of return you get versus the amount of cost of the trade. So perhaps I'll take a look at what people are saying here. I don't know if this is outside the realm or what. Let's see here. Where are you? Your stream started a little late. almost a minute and a half late. Sunglasses and umbrellas, not today. Would you trade a contango backwardation strategy for Bitcoin and its futures? So a contango and backwardation, those are all what you would call calendar spread variations. And there is I wouldn't do a contango or a backwardation strategy for Bitcoin and its futures. And the reason for that is that the futures products, they have really no volume once you go beyond the front month. So if the current futures on Bitcoin are trading an August futures contract, the September futures contract has virtually no volume, so it's very difficult to do a contango or backwardation trade between those two. Unlike with oil, where you can go 1, 2, 4, 6, 8 months out, and they'll still have plenty of liquidity and volume where you could trade the front month versus that future month. And then so actually doing a contango or backwardation strategy makes a lot more sense. But with Bitcoin right now, that simply isn't the case. So what does the rest of that shirt say or show? Oh, okay. So it says, it's like a nightmare, isn't it? This shirt, if you noticed very carefully, right here has a signature on it. It's by Keith McCready. And this is from the movie Color of Money. That was the movie with Tom Cruise and Paul Newman and John Turturro and many others, including Keith McCready. And it was about pool hustling, and it was the sequel to The Hustler with Paul Newman and Jackie Gleason from many, many years prior to that. One of the best pool movies ever, The Hustler, and then the sequel, Color of Money. And this is from a very particular scene where Tom Cruise is coming out of his shell of pretending to be just another average player, and then putting on his hustler against the top money player in the world, Grady Seasons, who was played by Keith McCready. And Keith, is getting the better of Tom while he is holding back his speed in this tournament. And then Keith says to Tom, "It's like a nightmare, isn't it?" Because he's smucking him while Tom is struggling and saying, "Man, I just want to break out and stop holding back my speed and just kill this asshole." And then finally he does, and he blows him away. But then all the odds for him in the green room and outside the tournament go haywire. Anyways, that's one of my favorite scenes in movies. It's like a nightmare, isn't it? So now you know. Ernie, have you heard Tone Vay's law review on YouTube? I've seen that he's done some reviews of various legal aspects, but I'm not really paying that much attention to it, quite frankly. So he has a few law experts reviewing the Michael Turpin's lawsuit against AT&T, and they're discussing the negligence on AT&T's part because this is the second time they've posted Turpin's phone. And that's interesting, and I'm actually going to follow that, and so I will be interested in looking at that episode. As many of you know, I recently settled with AT&T rather than going forward with a suit, because the suit would have cost way too much. And the AT&T, they allowed somebody to steal my identity and then use that. They then used my phone number and the SMS feature as a non-repudiated way to change the passwords on my accounts. And then they went and they deleted my YouTube account. So apparently this other case that's going on right now where someone lost, I don't know, $224 million worth of Bitcoin or something like that. Maybe it's not that much, maybe it's less, whatever it is. He's now suing AT&T for allowing somebody to also steal his identity and then use the phone to eventually break into keys that, for his exchange and steal all his crypto. So I'm going to be very interested in following that. Now, I did sign a non-disclosure with AT&T, so there's not much I can do right now, but I am going to be very interested in following this along. So yeah, I am very, very interested in that. So I have to just sort of settle, be happy with the settlement that I got, not follow through. That's pretty much it. So anyways, as I said, this is a show on, I wanted to introduce statistical arbitrage to you, and also a number of other strategies that I'll be introducing in the future. I think statistical arbitrage, although it seems like a really heady pursuit, it's really not that difficult. There are certain pairs that are very easy to trade, and you can really make a lot of profit with very little risk. And the really great thing about this is that even in the event, if you're doing this sort of pairs trading, this arbitrage, this long-short hedging, even in the event of a market crash, these types of trades won't typically blow up on you. They'll all be very well contained, and you can handle even flash crashes. That doesn't mean that they're without risk. Still requires some diligence, but they are very effective ways of trading. This is, again, how pros trade. Now, retailers may find that this is way too much work, and they are going to continue down that path of how to lose, and that's fine. But if you're interested in learning more about this, let me know. And I'd be happy to talk about it, maybe introduce some of the math into all of this, although I don't believe that that's quite necessary, because we're not hedge funds. We're just trading. We're not trading hundreds of assets together. We're trading a few assets. But you can still get the same kind of effect, that same kind of hedging effect, and increase your probability of profit and your return on capital, and reduce the risk, and not fall to that broker narrative and just throw your money away like 90% of most traders do. All right, so the first time they promoted Turpin, that they would put extra features so it couldn't get ported, and apparently is actual AT&T employees working with hackers to steal people's identity. That's what I'd like to find out too, and so that would be very interesting to me. Can statistical arbitrage be applied with stocks into the same industry? Yes, as a matter of fact. So for instance, if you can find two highly correlated stocks, and there are ways to do this, there are actually tools online where you can take two stocks and then find out what their correlation is. A correlation of, say, 0.7 or above is about what you want. So let's say take the auto industry, for instance, Ford versus GM. They may be two very well correlated stocks to trade against each other. But there are other correlations that you may find. For instance, did you realize that there's actually a correlation between the auto industry and certain precious metals, particularly platinum and palladium and rhodium are all platinum group metals? And that's because platinum is used as a catalyst in the creation of catalytic converters that are used in virtually all petrol-based vehicles. So there's a relationship there. There are other relationships. There are certain industry indexes that have relationships to bonds, as well as the dollar versus bond and others. There are many stocks that have these kind of relationships. But that, when you start dealing with a bunch of stocks and trying to figure out which ones to go long and short, there's a lot more work involved there, a lot more math. And so that's why I'm sort of introducing the idea of this very slowly, and start talking about futures and even Bitcoin and some cryptocurrencies as where you would start with statistical arbitrage, pairs trading. I really appreciate that, Crypto Bacon. I've been following that story with AT&T very intently. But right now I'm happy with my settlement, and that's pretty much all I can do. Can you use hedging in statistical arbitrage for foreign exchange? Absolutely. You absolutely can. One of the pairs that I like trading is the Aussie dollar versus the Canada dollar. It's almost like a proxy between gold or precious metals and energy, because the Aussies are well known as one of their primary outputs in their country is precious metals, mining, where Canada, its primary output is oil. So yeah, that is a very strong relationship. And there are other relationships that are definitely worth looking at. Euro versus the British pound, as an example. So anyways, I'm going to stop this right here. It's going to get a little bit heady. We might talk a little bit about Bitcoin for now. Let's see where we're at there. So what I'm going to show you is tensor charts. And with tensor charts, let's take a look at the daily view. So what we're forming here is what appears to be a bearish flag. After this huge move down, we've got this bearish flag forming here. And you can see that we're also diminishing volume in that same time period. That is a very strong indicator that follows along very nicely with my volumetric principle number 2. After a strong move down and then some consolidation with diminishing volume, there's a high likelihood that price will continue from the predominant trend. All right, so we're looking at that going down from there. Now, of course, let's take a look, go back to it's going to go back here. Going back to another Bitcoin chart. I'm going to look at the Bitcoin chart on TradingView. All right, so we can see that, I've drawn in this bear flag using a parallel channel, and we can see that we're where I thought it might end up, but we could conceivably go much further. We could go out like this very easily. I don't believe price will get much beyond 6,700 if it does come up here. But I think eventually we will then move down, and that will look something like this. I think we'll go down pretty hard too. Ernie, do you need to put up a disclaimer in the beginning that this is not investment advice, but a discussion in order to not get in trouble? No, I don't, because I'm really not giving any advice here. I'm just explaining what statistical arbitrage is. I'm not suggesting anything to trade in. As a matter of fact, I'm telling you don't. This is only an introduction to statistical arbitrage and how it might be used, or what peers trading is. So if someone really thinks that they need a disclaimer, well, then I guess that's on you. No disclaimers here, not guaranteeing anything, not even suggesting anything to trade. I'm just telling you what statistical arbitrage is. It's a type of pairs trading. This is the primary method of institutional traders and hedge funds. I can help you scale it down to a retail level, and this falls right in line with the thing that I always profess, and that is trade multiple non-correlated strategies. This is, in fact, in my view, the holy grail to trading, but that's only part of it. The other big part of it is creating the systematic approach. Now, if you'd like to learn more about it, this is where I can help. This is what I do as a professional. I am a professional trader coach. I also coach for entrepreneurs, and I have many clients that I'm working with right now. So if you'd like to learn this methodology of trading, it takes a bit, and my full course can last half a year or a year, but you'll learn what I consider the professional way to trade. Anyways, I've talked about that at great length. If you're interested, go to my website, traderoffutures.com, fill out a coaching application, and we can talk. Ernie, have you begun scaling into Bitcoin shorts yet? If not, what price will you begin? I would say that the next rally up anywhere around 66, 6,700 would probably be a good place to add to the shorts. I'm already enjoying the short that I executed from a cost basis of around 7,500 down to about 6,100. So I'm waiting for another move up, and then I'll short from there. Are you also backing up videos just in case? Yeah. Ernie, new room. No, this is actually a vacation home on Martha's Vineyard. So yeah, it is a new room, but it's not necessarily a new room. It's a new room to you guys. All right. That's all I want to go into today. I will start talking more about statistical arbitrage and pairs trading. Please hit the like button, share this video. There's going to be a lot of great content on trading. I will start talking about individual assets and classes of assets, how to perform fundamental analysis on them. So there's a wide range of things that I'm going to cover over the next many months. And again, if you're interested in a trading coach and you'd like to learn more about these methods, these professional methods of trading, go to my website, Trader of Futures, and fill out a coaching application. All right. So anyways, that's all I've got to say right now. For those of you that are interested in Neo's progress, he's doing fantastic. He seems to have made a complete turnaround. Now, that doesn't mean he's out of the woods with his cancer yet. There's a long ways to go. Here he is right down there. But he's doing really great, and we're really happy. He's playing with his brother, Obi. All right. Thank you, everybody. We'll see you tomorrow. Take care.